So welcome everyone to our 2023. It's a new season of our podcast, and the aim of this podcast really is to support founders, funders, and growth and emerging companies on how to access pools of capital, and that's what we specialize with Every Advisors. I'm joined by Brad Furber, the CEO, and we will just be going through some of the key topics that we feel will be hugely beneficial to our audience. So, Brad, how you doing?
Doing great. Good to see you. Happy New Year.
Happy New Year, Brad. So, Brad, there's so much to talk about, but there is one thing I wanted to kick off with. From the data that we have, obviously we work with companies all around the world, but we do have a huge clientele in Europe. Some of these companies, they've taken our programs, they've been on our masterclass, they've been on a quick fix, and some have even joined the Venture Finance Academy. But Brad, what can you share with us? What insight can you provide in regards to the state of the VC market in Europe?
It's really interesting. 2019, 2020, and 2021, there was an explosion of funds that were raising capital all over the world, but Europe all of a sudden was catching up pretty quickly and was becoming, maybe half as big as the US. And it was growing rapidly, and there was a lot of good success stories. European venture-backed companies were raising larger rounds, not just from US-based, VC leads, but from European-based VC leads. And the way that VC firms obviously make money is through a liquidity event, right? They either get acquired or they go public. What's happening, unfortunately, over the last 2 years is that I read at the end of, around Christmas time, that more than 3/4 of European VC-backed companies that went public since the beginning of 2021 are trading below their IPO price, right? So the IPO, everyone thinks the IPO is a liquidity event, but of course it's really not. The liquidity event is when you can actually sell your shares. At the time of the IPO, these shares are typically locked up pursuant to an underwriting agreement and pursuant to securities laws. And so at the end of that lockup period, which could be, say, 6 months or up to a year or more, that's when you get liquidity. So if you go public at $20 a share and you're still locked up and now the stock price sinks to, say, $10 a share, that's not good. It's not good for anyone. But what it also means is that the valuations that some of these firms thought that they had and that they were going to capture, they don't have it anymore, and they're not going to capture it unless, of course, the market rebounds. So that's a really interesting statistics, right? So the other thing is the VC backed IPO activity has also slowed. And so in 2022, they saw the fewest public offerings since 2019. So that's interesting too. So the market for IPOs is smaller in terms of deals done. And even those who did get out into the market, most of them, more than 3/4, are trading below their IPO price.
Wow.
There you have it.
That is not encouraging. I mean, by the way, what's the relationship between the public market valuations and the VC valuation?
Glad you asked me that question, because there was another article that I read that got me thinking, which was talking about how the public market, because, there's a stock market and there's an opening and a close every day, every day what the value of the stock is, the market cap or the share price. So there's transparency. The VC market, there's a lack of transparency. And so if, for example, you made the investment in, say, 2021 and you invested at, let's say, whatever, 100 million valuation or 500,000 or 50 or a billion, whatever it is, you can continue to hold your investment at cost until you decide that you need to change it. Now, there are some rules regarding it, but by and large, it's pretty opaque, and different firms actually can make different decisions depending on a lot of different factors as to why they might want to revalue the portfolio. But the bottom line is, sooner or later, a day of reckoning comes. And what I think is interesting about this lag, so let's just talk about ARC Innovation, for example, which is Cathie Wood's firm. It was kicking ass. It's an ETF. It's totally in on disruptive innovation. Actually got to hear her speak, by the way, in Lisbon a few months back. She's an interesting woman. But she's just, her whole investment hypothesis is disruption, innovation. I'm going to go with the crazies, the ones who don't want to just go to the moon, the ones that want to go to Mars. Those are my people. But who is investing in ARK? Well, she allowed individual investors, retail investors to invest. Honestly, very few of the big institutional investors that typically back VC were investors in ARK. Meanwhile, the big endowments, the universities, the pension funds, the ones who have been pumping tons of money into both private equity and venture capital, up to the point where, these are records amount into what are illiquid investments. For some reason, they were thinking, well, if I invest into these VC funds and the VC funds or the private equity funds manage it, even though it might take 3, 5, 7 years, that's where I'm going to get the big returns. And that was true. That was definitely true for quite a while, definitely from about 2014 on. But it's not true now, is it? And so when you look at these investments that are held by the VC funds, to the extent they haven't marked their current value to, say, what the public markets are doing on a daily basis, what's interesting is that normally when you value a company, you get what's called a discount for non-marketability, right? So if you've got a security and you can freely trade it, then you should theoretically have a premium. If you've got a security that's non-tradable and or doesn't have control, there's both a discount for non-marketability and for control. You typically might see a 30, 40% discount. So theoretically, going public should increase the value of the security because it's freely tradable. But in fact, in the current market, that isn't happening yet. The public companies are trading at a discount to the quote valuation of the privates, right? Which is an odd thing. And it's not sustainable. I mean, sooner or later, the bill always comes. But as of right now, the bill hasn't come. And so I think there's a lot of people who are going to bed at night, thinking that the value of their portfolio is higher than what it really is. That's interesting.
That would cause extreme anxiety. I mean, for any sort of founder or co-founder that's watching this, that has some kind of reassurance in the value of their company and now discovering that may not be the case, what could they do right now to mitigate a horrible situation when it comes to the valuation?
Well, the conventional wisdom is cut your burn, extend your runway. If you can raise more money, even on the same terms as 2 years ago, or even maybe at a slight discount, just extend your runway, because the last thing you're going to want to do is run out of money. That's when you find out the true valuation. We've seen this in some of the clients, they put together these pitch decks and they're like, well, yeah, we think, the valuation's based on a price to sales ratio of X. And you're like, really? The companies in the public markets, which typically get the high end of the ratio, are half of what you're saying. So that might not be true. So you just got to be real. You got to say, look, even though the public markets and the private markets operate differently, at the end of the day, the private markets follow the public markets. It might be 6 months, it might be 12 months. They aren't different. At least in my view, they're not different. They just, there's a lag time.
Thank you, Brad, for that insight. It certainly would be prudent for, I think, a lot of founders right now to just get a second opinion on their valuation, get a second opinion on their position in the markets for a lot of companies out there. But, I would also be intrigued to find out, Brad, what do you think 2023 entails for early stage startups that are looking to raise money this year? What are the things they need to know? What are the trends? What can you share with them that will help them on a journey for this year of fundraising?
Okay, well, I tend to be fairly data-driven. I can, of course, talk about my own personal experience based on my own personal deal flow, client base, so on and so forth. But that's not as relevant as the big ticket data, right? The data never lies. And so the data suggests that the market, the so-called headwinds that existed in 2022, they still exist. what are those headwinds? There's a lot of them. The war in Ukraine. Nobody knows, what's going to happen there, creates uncertainty. Inflation, right? You got rising interest rates, which changes a lot of things. You've got interest rates, inflation. You've had this global supply chain problem. Now we're post-pandemic, so some of this ice flows are they're unfreezing and things are opening up. You got the China issue, right? China just came out of the strict lockdown, and all of a sudden you can both visit China and Chinese people can go and visit the rest of the world. You've got a decoupling of the supply chain, where all of a sudden it's not just Donald Trump saying, no, you can't trust China. Now it's the whole West sort of saying, hey, we need to, even if we pay more, we need to have an ability to source materials locally, so on and so forth. So you got a lot of things that are challenging. So what does that mean for early stage companies? The good news for early stage companies is there's a lot of dry powder, right? I mean, the world went crazy. The financial markets just stuffed a ton of money into the professionally managed venture capital, private equity. That money has to be deployed. I mean, they get paid, keep in mind, 2 and 20 or whatever, they get a management fee on it, plus they get carried interest. When if you're not doing any deals for any sustained period of time, your limited partners are going to say, hey, maybe you don't need that money. We don't want to pay management fees on idle capital. So there's pressure, but the difference is, and I think when I went to Web Summit in Lisbon, it was a well-attended event. There was a lot of activity there, so people are still engaged in the space. But one of the comments, there was a bunch of sort of people up on the panel that work with a lot of different accelerators in different markets. They said, look, the days of the founder-priced party round are over. The party's over. The party round thing where the guy just says, yeah, we're selling a safe and the cap is, say, $30 million. This thing is hot deal. You got to get your money in by next week. And then the investors, were pouring money into these deals at crazy valuations with almost no due diligence. That's not happening anymore. Now it's like, okay, I'm still actively evaluating deals, but, I'm going to do more due diligence. Give me some time. I'm going to have to go through the valuation, the deal terms. Everything is maybe a little different. What does it mean? I mean, if you've got a good company, innovation, it's still happening. But I think that the volume and the velocity are going to continue to be a problem in 2023. You can still raise money. There's money out there, but it's going to be harder. I think the valuations and the deal terms will be tougher for the entrepreneur, and it's just going to take longer to get from beginning to close.
Wow. So it sounds like there needs to be more patience. If deals are being done differently now, if it's going to take longer to dot all the I's, cross all the T's, and, investors are being more diligent now, would you say founders need to factor that in terms of the time scale in raising funds?
Yeah, that's right. They need to, just this idea that you're going to fool somebody into making a decision prematurely, otherwise they're going to miss out, the FOMO thing. I don't think there's a lot of FOMO in the market right now. In fact, now there's a lot of regret, like deals that I wish I didn't do, and now I got to sort through the portfolio and figure out, and this is hard, right? Which ones I'm going to kill, or not feed, I should say, not kill. I think there'll be a lot of M&A, so as companies start to run out of runway, that's a problem for two reasons. They don't have the money to invest in innovation, right? So now they have to be more conservative. And it may be that there's other companies that if you combine forces, there might be good reasons for companies that might not have wanted to do M&A because they wanted to shoot for the moon, who now say, we'd be better off cobbling together, our team and our technology with maybe one or two others because it would be a more compelling thing. That's not easy to do, by the way, because you got cultural issues and founder issues and egos and stuff, cap tables, which is expensive because there's lawyers' fees, M&A. But I do think we're going to see more of that, just like we did, in the dot-com collapse years, there was a lot of opportunity for M&A within the seed and even the VC-backed companies. The ones, they're not going to get to an IPO. The IPO market's not dead, but it's slowed.
So when you say M&A, are you referring to mergers and acquisitions?
So yeah, mergers and acquisitions. So the way any startup ultimately achieves liquidity is either through a sale, a merger, or an acquisition, or through an IPO. So since the IPO market's pretty well dried up, not totally, but it's not, the window's not very big right now, then the question is, okay, can we continue to do what we need to do by raising more money from our, private market sources, or should we just sell the company? And I think a lot of them are going to decide to sell the company. Like, hey, we're done. We can't do what we thought we were going to do. We have a nice little business here, but we need to bolt on to some other vehicle that can take what we built and figure out how to commercialize it.
Although there's challenging times ahead, Brad, and I certainly from our conversation today, one of the things that startups and founders can do is basically get a competent and experienced venture finance advisor to help them. But what other things do you think can be done in this current climate for startups that are looking to raise money this year in 2023?
What other than the usual things, I think the number one thing is batten down the hatches, get rid of any unnecessary people or unnecessary projects, figure out what not to do, focus on your strengths, both from a people perspective and from an opportunity perspective, including technology. Don't do stupid stuff. Get rid of the underperformers, batten down the hatches, continue to innovate. Don't waste money, essentially. I think when it comes to the hard thing, in my experience, is if you're the CEO or you're the senior leadership team and there are 10 or 12 different things that you could do, but you're not sure which one to do, and you also may feel guilty because you've recruited people to the company, they've made an investment of their time, maybe their families have moved, and now you realize, hey, we can't keep everyone. It's lifeboat time here, and I know it's kind of harsh, but we need to figure out who's going to stay in the lifeboat, and then you need to figure out what do you need to do to get the people off the boat in a way that is ethical, in a way that's fair, but in a way that can be done quickly, right? Because delay is not your friend. And so I think if you have objective people who you can say, look, this is the new plan, we need to execute the new plan, just do it, right? But you might need some fresh ideas. If you got the same people who created the mess, who also need to fix the mess, they kind of have a conflict of interest. You might need some new people at the table to come up with a new solution to fix the problem. And that you could bring those people in, as advisors, professional advisors, various kinds of advisors. If you got a good board of directors, maybe they'll do it. With early stage companies, a lot of times, in my experience, the board is pretty weak, and in part that's by design. The founders, in the good old days, be like, oh, don't bring in these outside directors because you could, quote, lose control, which is true. But now if you don't really have any objective advisors at the board level other than the people who created the mess, it's tough. Sometimes you got to have a bad guy, good cop, bad cop, hey, we love you. We brought you in when we thought we had more money, more runway. The markets were different. Russia wasn't, invading Ukraine. A lot of things have changed. Interest rates, inflation, we got to have a new strategy. Okay. And you just got to change. And sometimes you need new people to come up with fresh ideas.
Again, that's why I think it's super important for any professional in this position of a CEO or of a co-founder that's experiencing the challenges that you've just mentioned. They certainly should reach out, book a consultation with you, get an objective sort of opinion or an overview of their situation, because I can imagine, I've been a CEO of a company before and I've had staff, and the hardest thing to do is to cut back, because you've made promises to people, you made a commitment. You believe as a leader of a company that you can always turn things around, and it's very, very hard not to bury your head in the sand when things are going bad. As you said, if you can have an advisor, if you can have someone that's objective, that can literally just advise you on the best things to do, a trusted advisor, I think it will go a long way, especially in the climate that we're in today. So as I mentioned, Brad, is all well and good us saying, seek independent advice, objective advice, but the ability to accelerate the tough decisions. Why is coaching specifically something that can save you a lot of time, money, and expenses?
Well, I think one of the things that you get if you do pay somebody to be your coach is you kind of feel guilty if you don't do what was agreed to a certain extent. So let's just say that there is an agreed, plan, and then at the next meeting, the stuff hasn't happened. It's not the coach's fault necessarily. Now, you can crack the whip, I suppose, and depending on what the relationship you want to have. It's been my experience on both sides of this fence that if sometimes you need somebody to hold you accountable, and sometimes the sense of urgency is, especially if you're dealing with something you don't really know what to do. So you follow the advice, you check in, you say, okay, I did A, B, C, and D. Okay, great. What about E? E needs more work. And so you can create this, feedback loop so that hopefully you can do whatever it is you want to do, but you do it faster and better and smarter, in part because you've got somebody working with you who's been there and done that. And so, we've got this thing that we call the quick fix. And sometimes, like there was a recent client, couple of guys, smart guys, they bootstrapped their company. They've been pretty successful, didn't have to raise any outside capital. But then they realized that their ability to grow would be aided by engaging in M&A. So they found somebody who was their competitor, who I guess was tired, and they said, hey, why don't you sell us your business? You did, but in order to do that, they had to raise money, some of which was available by debt, and some of which they needed to raise from equity. Unfortunately, they got a little bit of time to raise that equity to pay the full purchase price. And so the clock is ticking. And there's a strong sense of urgency. I think it's been helpful for them to have somebody coach them to do what they need to do, which in this case is put together all the materials and the pitch and the offer, which is important, that has the potential to attract the capital that they need to complete the acquisition and do other acquisitions like it. Because I think they see kind of a roll-up opportunity. There's organic growth and there's M&A growth. Honestly, there's a huge market to acquire other companies right now, because I think a lot of people are going to be tired and weak, and they're just going to say, hey, end this, please,
Put me out the misery. Okay. Now, and I think there is something to be said about accountability, because if everyone did what they needed to do, there wouldn't be a need for coaches, there wouldn't be a need for advisors to some degree. But I do know, specifically when it comes to coaching, one of the big things that always comes up is accountability. We don't always do the things that we need to do when we need to do it. And that's one of the most valuable things with having a coach, is that they remind you and they hold you accountable. Especially the tough decisions, the tough things that need to be done, they remind you of that. If you're a founder or a CEO or a co-founder, and you have a company and you're faced with some of the challenges that we've mentioned today, reach out to us. It's super important for you to have some support on this journey. Reach out to Brad. He's experienced in this, and it will most certainly benefit you from having an objective view on exactly where you are, so you can make the best decisions moving forward.
In a nutshell, as we enter 2023, I think it's important for anyone who's a founder or a funder, particularly of an early stage company, to take stock of the current market conditions, to look in the mirror and be objective and say, okay, what are we doing now that maybe we should quit doing? Do we have people or projects that we need to stop investing in? And what is our strength? And how are we going to make ourselves leaner, stronger, with a better runway to achieve the overall objective. So I think it's time to get really creative and think a little bit like Ernest Shackleton did after his ship got stuck on the ice, which is, hey, we may need to spend a few months or longer here. It's going to take us longer, but let's figure out how to save what we, do best and get rid of anything that's unnecessary. That's what I would do, both if I'm the CEO or if I'm an investor, try to convince the CEO and the management team that that's the smartest thing to do right now.
Thank you very much for joining us on our podcast today. We're going to have a lot more episodes coming out over the year. Please remember to subscribe and to click on the bell button so you can be notified of when those new episodes are being released. Don't forget to make comments, because we will read our comments and we may well include them in future episodes. And don't forget to reach out to us if you have any questions. You can always contact us on info@areaadvisors.com.